All right, so we're diving deep into the magic formula today.
Yeah, breaking down how it works and how to use it.
Exactly. And to really get it, we got to start with the basics.
Lay the foundation.
Exactly. Like, what's the minimum return we should expect from AAVI investment?
That's where the risk-free rate comes in.
Uh-huh.
U.S. government bonds.
Okay.
They're basically risk-free because it's the government backing them up.
Right. Makes sense.
So let's use 6% as our benchmark, even if rates are a bit lower right now, just to keep things consistent.
Okay, 6%.
Yeah, that's your starting point, your bare minimum, before you even think about taking on any risk.
So 6% is like the floor.
Yep.
And anything riskier has got to offer us more potential for a better return.
Absolutely.
But let's be real, most of us aren't exactly thrilled with just 6%.
Of course not.
We want our money to grow faster.
Right. Which brings us to investing in businesses.
Okay, so before we jump into the stock market,
Yeah, let's take a step back.
back to the basics.
Yeah, how do we even figure out what a business is worth?
Right? How do we put a price tag on a whole company?
Well, it really boils down to future earnings.
Future earnings.
When you buy a share of a company, you're basically buying a piece of those future profits.
Okay.
But the tricky part is those future profits are uncertain.
Oh, yeah.
They can change like crazy based on all sorts of things.
Which is why stock prices are always bouncing around, right?
Exactly. They're trying to predict those future earnings, and any little news or change in feeling can send them up or down.
Yeah, makes sense.
And to make things even trickier, sometimes those price swings aren't even rational.
Irrational.
Yeah, enter Benjamin Graham's famous analogy.
Okay.
Mr. Market.
Mr. Market, he sounds like a character.
He is. Imagine this emotional, sometimes manic-depressive guy shows up at your door every day, offering to buy or sell you shares of businesses.
Wow.
And sometimes his prices are reasonable. They reflect what the company's really worth. But other times,
Yeah?
driven by fear or greed, he offers prices that are totally out of whack.
So it's like he's having a yard sale, but instead of old junk, he's selling pieces of companies, and his prices are all over the place depending on his mood.
Exactly. And that's where smart investors come in. They recognize when Mr. Market's being irrational.
Oh, so we wait for him to freak out and offer us amazing deals, or when he's feeling super generous and we can sell high?
You got it. But how do we know when Mr. Market's being irrational? How do we figure out the real value of a business so we know when to buy low and sell high?
Yeah, that's where I get lost. There's so many things to consider, so much information. How do we even start evaluating a company?
That's where the magic formula comes in. It gives us a framework, a set of criteria to cut through all the noise and find those companies that Mr. Market might be undervaluing.
Okay, I'm intrigued, but before we get into the specifics of the magic formula, let's talk about this undervalued thing. How do we actually know a company is trading for less than it's worth?
That's where two key things come in: earnings yield and return on capital.
Okay.
Think of earnings yield as the interest rate you're getting on your investment.
Okay, like a savings account.
Exactly.
Right.
It tells you how much a business earns compared to its current price.
So a higher earnings yield, the better.
You got it.
Right.
Just like you want a high interest rate on your savings account. Well, you want a high earnings yield on your investments.
Makes sense.
But earnings yield alone isn't enough. We also got to consider how well a company can reinvest its profits to make even more money.
Right, so it's not just about making money, but what you do with it.
Exactly. That's where return on capital comes in.
Return on capital. So is that all about efficiency?
Exactly how well a company uses its money to make more money.
Got it.
A company might have a high earnings yield, but if they're terrible at reinvesting those earnings, it's like pouring water into a leaky bucket.
Yeah, you're not going to get very far with that.
Nope. You want a company that could take those profits and turn them into even bigger profits down the road.
So a high return on capital means the company is a well-oiled machine, constantly churning out profits and creating value.
Precisely. And that's what the magic formula focuses on, these two key things: high earnings yield and high return on capital, to find companies that are potentially undervalued by the market, those hidden gems that Mr. Market might be missing.
Okay, I see how this is all coming together. The magic formula helps us spot those Mr. Market moments when we can buy good businesses at a bargain. But I gotta ask, if this formula is so effective, why isn't everyone using it? It sounds almost too good to be true.
That's a question a lot of people have.
Hmm.
And there are a few reasons why the magic formula might not be as popular as you'd think.
All right, let's unpack those reasons. What are the potential drawbacks or challenges that might be holding people back? So if it's so great at finding these undervalued companies, why isn't everyone using it? What's the catch?
Well, no catch, really. But there's some things about it that make some investors hesitant.
Okay.
Like, it takes a lot of patience, which not everyone has.
Yeah.
The magic formula isn't about getting rich quick.
Oh, so you're not going to see huge returns right away.
No, it's more about trusting the process and letting it work over time.
The long game.
Exactly. The magic formula is built on the idea that the market will eventually fix itself,
Okay.
that Mr. Market will sober up and see the real value of a company.
Okay.
But that can take time, sometimes years.
Yeah. In today's world, waiting years for an investment to pay off can feel like forever.
You can. And that's why a lot of investors get tempted by the idea of fast profits and jump from one hot stock to the next.
Chasing trends.
Right, trying to time the market.
But like we said, that's super hard to do.
It is, even for experienced investors.
Right.
The magic formula is all about ignoring the hype and focusing on the fundamentals, those key numbers we talked about,
Sure.
earnings yield and return on capital.
Buying good businesses at a discount and waiting patiently for Mr. Market to come around.
Exactly. And that waiting can be tough, especially when the market's doing poorly and your portfolio's down.
Which brings us to another challenge, the psychology of investing.
Oh, yeah.
It's one thing to get the logic behind the magic formula, but it's another thing entirely to actually have the emotional control to stick with it when the market's testing you.
You're right. Fear and greed are strong emotions, and they can easily mess with our judgment even when we have a good plan.
So how do we fight those emotions? How do we stay disciplined and not make rash decisions that could hurt our long-term goals?
One key is to really deeply understand how the magic formula works. It's not enough to just blindly follow the rules.
Mm-hmm.
You need to really believe in it, even when your portfolio isn't doing well.
So it's about conviction, trusting the process, and knowing that those ups and downs are just part of the game.
Exactly. And it also helps to have a plan in writing, a real investment strategy that lays out your goals, how much risk you're willing to take, and your rules for buying and selling.
So you don't panic and make emotional decisions.
Right. Having that plan can help you stay grounded when the market throws you a curveball.
Like a roadmap so you don't get lost.
Exactly. But let's switch gears a bit and get practical. For people who are ready to try out the magic formula, where do they even begin?
Yeah, where's the starting line?
The great thing about the magic formula is that it's simple. It's not about complicated algorithms or insider info. It's just a systematic approach that anyone can follow.
Okay, so break it down for us step by step. Where do we start?
First, you need to figure out your investment universe.
Investment universe.
Yeah, we're not talking about the entire stock market. You'll want to focus on companies that are big enough to have their financial data public.
So like companies that are worth at least $1 billion.
That's a good starting point. It makes sure there are enough shares available to buy and sell easily.
Okay, so we've narrowed it down. What's next?
Next, we apply the two key criteria of the magic formula: return on capital and earnings yield. Remember, those are our guides for finding potentially undervalued, high-quality businesses.
And there are websites and stuff that can help us calculate those, right? We don't have to be math geniuses or anything.
Exactly. Many investment platforms have these screening tools that let you filter companies based on those specific things. It's like a search engine just for magic formula stocks.
That's awesome. So we've got our data, we've set our filters now. What?
Now it's time to rank them. The magic formula ranks companies based on their combined scores for return on capital and earnings yield. The higher the score, the more interesting the potential investment.
Like a competition, the top of the list is where we focus.
Right, but I bet even with this data-driven approach, it's easy to get attached to certain companies, to fall in love with a stock.
Oh yeah, I can see that happening.
But remember, the magic formula is all about taking emotion out of it. It's about diversifying, spreading your risk across a bunch of these high-scoring companies.
So don't put all your eggs in one basket.
Exactly. It's about betting on the average, not trying to pick this single winning stock. And speaking of averages, the formula suggests holding these investments for a certain amount of time, usually a year.
Okay, so no day trading. We're in it for the long haul.
Exactly.
Yeah.
After a year, you look at your portfolio, again, recalculate those metrics and maybe sell some companies that have dropped in the rankings and buy new ones that have moved up.
Like an annual checkup for your investments?
Exactly. And here's an important point. The magic formula isn't about finding obscure, unknown companies. You're likely to see some familiar names on your list, but maybe companies that Wall Street has overlooked or underestimated for some reason.
So we're not investing in risky penny stocks or companies with no history. We're looking for solid businesses that might just be temporarily out of favor.
Exactly.
Oh.
And while there's no guarantee every magic formula pick will be a winner, the data shows that this approach can lead to better returns over time, especially when you combine it with thorough research.
Research, that's a key step that a lot of investors skip, right? It's
Yeah.
not enough to just look at the numbers. We need to actually understand the businesses we're putting money into.
Absolutely. It's about looking deeper than just the balance sheet and income statement.
Yeah.
It's about reading industry reports, understanding the competition, and evaluating the management team.
So it's about combining the numbers with the story, being an informed investor, not just a number cruncher.
Exactly. While the magic formula can help us find potentially undervalued companies, it's our job to do our homework and make sure we're comfortable with the businesses we're investing in.
So we've done our research, picked our magic formula stocks. Time to buy right.
Hold on a sec.
Yeah.
Before you hit that buy button, it's important to think about how much risk you're okay with taking.
Risk, the unavoidable part of investing.
It is. No matter how data-driven we are, there's always uncertainty.
Right.
The magic formula has a good track record, but it's not immune to market crashes or unexpected events. Diversifying helps reduce risk, but it can't completely eliminate it.
So how do we figure out our own risk tolerance? It seems like such a personal thing.
It is, and it depends on a lot of things. Your age, your financial goals, your job security, how comfortable you are with the market going up and down.
So a younger investor with more time might be okay with more risk than someone closer to retirement.
Exactly.
Yeah.
And someone with a steady job and a big emergency fund might be more willing to weather market storms than someone living paycheck to paycheck.
It's about finding that balance between potential gains and potential losses, a balance that lets you sleep at night even when the market's making headlines.
Precisely. And remember, it's okay to be risk averse. If you're not comfortable with the stock market's ups and downs, there are other options like bonds or real estate.
Right. So we've covered a lot here, from the psychology of investing to the steps to using the magic formula. It seems like it takes real commitment, discipline, and a long-term outlook.
It does. But for those willing to put in the work, trust the process, and stay focused, the magic formula can be a powerful way to build wealth and reach your financial goals.
But let's be realistic, not every magic formula pick will be a winner. We'll probably have some losses along the way. How do we handle those setbacks? How do we avoid getting discouraged and giving up on the whole thing?
That's a great question. And it comes back to really understanding why the magic formula works, having that strong belief that this approach, despite its imperfections, can lead to great returns over time. It's about having the mental toughness to ride out those rough patches, knowing that the market doesn't always reward good companies right away.
It's about trusting the process, knowing that eventually the market will catch up to real value. But speaking of time, we're running short today.
We are. But before we wrap up this part of our deep dives, I want to touch on something important that often gets overlooked, the impact of taxes on your returns.
Oh, right. Taxes, the unavoidable part of investing.
Exactly. And if you ignore them, they can really take a bite out of your profits over time. But the good news is there are smart ways to lower your tax bill and still maximize your magic formula gains.
Okay, I'm listening. What are some of those tax-smart moves?
So let's dive into those tax smart moves. The first thing to consider is using tax advantage retirement accounts like 401k and IRAs.
Those are the accounts where you get a tax break now or in retirement, right?
Yeah, exactly. The choice between a traditional or Roth account depends on your situation, but both offer big tax advantages for long-term investors.
So even before we pick stocks, we're already thinking about taxes.
Smart, definitely.
Mhm.
But what about those who are already maxing out their retirement contributions? Where else can they invest while minimizing taxes?
Yeah, good question.
That's where a taxable brokerage account comes in. You'll pay taxes on dividends and capital gains, but there are still ways to be strategic.
Okay, so what can we do?
One simple thing is to hold your investments for longer than a year. This gets you the lower long-term capital gains tax rates, which can make a big difference in your returns.
So patience really does pay off.
It does. And this is especially good for magic formula investors. Since the strategy already involves holding stocks for at least a year, you're automatically set up for those lower tax rates.
Oh, that's a nice bonus. Any other tax tips?
Absolutely. If you're into giving to charity, donating appreciated stock directly can be a win-win. You avoid those capital gains taxes on the shares, and the charity gets the full value of your donation.
So less taxes and doing some good. I like it. Now, you mentioned before that there are tools and resources to help with the magic formula. Can you tell us more?
Sure, we've got all this technology now. There's no need to do everything by hand. There are websites that offer the data and screening tools you need to find and rank magic formula stocks.
So no more spreadsheets.
Nope. Sites like Yahoo Finance, Google Finance, and Morningstar are great places to start. And there are also more specialized platforms that do the calculations for you, track your portfolio, and even suggest buy and sell decisions based on the magic formula.
Sounds pretty useful, like having a digital assistant for your investing.
Exactly.
Yeah.
But remember, even with these tools, it's still important to do your own research and understand the basics. Don't just blindly follow the software.
So use technology to help you, but still think for yourself.
Right. And as you get more experience, you might even want to tweak the magic formula to better match your own goals and risk tolerance.
Tweaking the formula. Interesting. Tell me more.
Well, the standard magic formula is a great starting point. But as you learn more about different industries and how the market works, you might want to adjust some things to fit your own investing style.
So, like, if someone's really into renewable energy or AI, they could focus the formula more on those types of companies.
Exactly. Or if someone's super risk averse, they could avoid companies with lots of debt or those in really unpredictable industries.
So it's about taking control, using the magic formula as a base, but making it your own.
Exactly. And that's one of the cool things about this approach. It's adaptable and can work for all sorts of investors.
But no matter how you use the magic formula, the core ideas are the same. Find companies with high returns on capital and good earnings yields, diversify your portfolio, stay disciplined, and think long-term.
You nailed it. Those are the keys to success with the magic formula.
Okay, we've covered a lot today: the magic formula basics, how to use it, tax strategies, and helpful resources. But before we wrap up, I want to leave our listeners with some key points to think about.
Good idea. Let's sum it all up.
First, the magic formula is all about data and value investing. It's about finding companies that are strong and undervalued, not chasing hype or trying to time the market.
It's about being smart and logical, not emotional.
Right. Second, remember, it's a long game.
Yeah.
It takes patience, discipline, and the ability to handle those times when things aren't going great. The market doesn't always reward good companies instantly, but over time, value usually wins out.
And really understanding the strategy is key. When you believe in it, it's easier to stick with it even when things get tough.
And finally, remember that investing isn't just about making the most money. It's about making financial decisions that match your values and using your wealth to make a positive difference in the world.
Couldn't agree more. Financial success is only meaningful if it has a purpose.
So there you have it. The magic formula might not be a guaranteed ticket to wealth, but it's a powerful tool that can help you navigate the market and potentially reach your goals. It's up to you to take charge. Do your research, stay focused, and keep learning. Happy investing, everyone.